Okay, in this tutorial, I'm going to be explaining how we can use liquidity to predict price movement. What we know about liquidity is that when the banks take liquidity, their next phase will be to create liquidity. So we can identify those phases in the market, especially on high time frames. We can dictate the next move. All right. Now, what I mean by that is if we're looking at price make lower lows and lower highs, lower lows and lower highs on a small scale or even on a big scale, making lower lows and lower highs, lower lows and lower highs, we know what phase is next if the market has broke the lower low. Now, an example of that would be just this. Notice GBP USD is making lower lows, lower highs, and then it made a lower low. When the market makes a lower low in a downtrend, we have taken liquidity from buyers. And if we've taken liquidity from buyers, when the market reaches a low and an area of support, we know that the next phase will be to create liquidity in order to go lower than this point. All right. Now, what I mean by that is once price gets to a certain level of support and the market does start to pull back, we are tricking buyers into buying, thinking that the market is going to reverse. Retail traders will buy off of this support and protect their trade by putting a stop loss below this low, which is creating liquidity. Now, I like to identify liquidity by putting RTD. That way, I know why I would trade towards that area. All right. Now, notice we made lower low, lower high, lower low, right? Now it's time for the bank to create liquidity because we just took money from buyers. So, like I said earlier, in order to go lower than this point, we have to trick buyers again and run price into a strong area of resistance. And if you look to the left, notice price is treating this line as support, and we've run into it as resistance. Now we have an opportunity to trade toward liquidity, right? Because that's what the banks are going to do. They're going to trade toward the liquidity, right? And that'll give us an opportunity to get into the trade with the banks, all right? Very, very simple. Banks take liquidity, run price into a strong area of support. We trick buyers into buying, and then our opportunity to enter the trade will be up here to trade toward the liquidity that we have identified. All right, very, very simple. And this is me showing you it on a large scale. All right. Now, notice the market does this on a small scale as well. If you look at price in this downtrend, notice every time the market makes a low, right, below any type of liquidity in the past, the market pulls back. When the market pulls back, it is creating liquidity below this low. Now we have an RTD in this area, a reason for the market to drop. And the banks will trick buyers into buying by pulling price back into an area of resistance. If you look to the left, notice we have a break and retest, and this line is being treated as support. So what we would do to enter the trade with the banks is we would enter above the RTD and we would trade toward it. And as you can see, market goes down. Now notice in the downtrend, it does this over and over again. All right, so notice we have now a break of structure, right? The banks ran price into a minor area of support. We tricked buyers into buying into an area of resistance. I'm going to move this down. Notice we're still treating this area as an area of support. And now we have another RTD below here because there are stop losses here from these buyers. The banks will enter their trade above the RTD, maybe on this bearish candle, and then notice what the banks do. They trade toward it, all right? And it just keeps happening over and over again. All right. It happens actually one more time right here before the market starts to reverse. We break below a low, right? The next phase is to trick buyers. Below this low now is your RTD. The banks will enter high in this area up here, or maybe right here at the crossover. And notice what the banks do. They push down past the RTD to take out the liquidity from the buyers who bought in this downtrend. All right. Let me show you an example of this in an uptrend. All right. Now notice this is a 15-minute time frame, and the market is making higher highs, higher lows, higher high, higher low. Every time the bank breaks structure and creates a higher high, like this is the bank taking liquidity from sellers, right? So I can kind of draw my pattern up in this uptrend, right? We've taken liquidity from sellers by stopping them out. Their stop losses were above this high. And now I know that the next phase will be to create liquidity. So they'll create liquidity by pulling price back into an area of support. Above this high will be my RTP, my reason to push, because I know stop losses are above these highs now, because this time we've tricked sellers into selling, not buyers, right? We tricked sellers into selling. When these people sell, they're going to protect their money by putting a stop loss above these wicks, and it's going to give a reason for the market to push, a reason for the banks to move price up. Your entries are going to be in this area here, right? Before price breaks above the RTP. That way you can enter that trade with minimal drawdown and go straight up, all right? Now notice we did the same thing again. We broke structure, all right? So now we've stopped out these sellers, right? And what are we going to do to continue going higher? Because we stopped out these sellers and we know that the bank has to create liquidity in order to go higher than this point, they'll trick sellers again, right? Your RTP will be above this wick because we know that if retail traders sold off of this minor area of resistance, above this high is liquidity, stop losses. This will be my reason for the market to push higher. Your entry will be in this area here at the moving average crossover before price breaks above the RTP, and we'll trade toward it with minimal drawdown. All right. Very, very cool, right? So having that understanding about the market, when you're analyzing higher time frames, you'll be able to predict an opportunity, especially if you're a scalper or intraday trader. If you go to the 1 hour time frame, right, I can do the same thing to figure out why price is in this area. Right now, notice on the 1 hour time frame, we have higher high, higher low, and a higher high. So if the market just created a higher high, I know why we're doing this. And it's because we're in the phase of the bank creating liquidity. If we broke above a high, right, and the market started to pull back, we must have run into an area of resistance, right? And now the market is pulling back, creating lower lows, lower highs, and lower lows. Now, because we know the world is big on this 1 hour time frame compared to a 5-minute or a 1 minute time frame, we can dictate the next play based off of what phase the market is in when we get to the chart. All right. Now, we do know that if we had came to the chart after the market broke below this low, right, we know that in order for the market to go lower than this point, the bank has to create liquidity and has to run into an area of support. So if I draw a line here and look left, we have a break and retest, right? Which means this is an area of support. If I put a box in this area right here, I know this is an opportunity to buy, for a quick amount of points to the upside. Low probability because we are kind of pulling back. All right. let's go to the 15-minute time frame, and there are my arrows. And as you can see, because I know the next phase is to create liquidity, the system is in agreement with me, and then you have oversold, signal line, bullish momentum, and an opportunity, to catch, roughly 100 points. That's around 91 points if you'd have stayed in that trade, right? And this is going against the trend, right? Now, if I go back to the 1 hour time frame, I can look at this price action and pretty much play out what the next phase is after the bank creates the liquidity. The market was making lower lows, lower highs, lower lows. We did have a break of structure, and we made a lower high. So if we made a lower high, right, then I know what is below this area of price action. Liquidity, right? Now, if there's liquidity below this low, I know the bank will want to trade toward it. So if you look at this, we have the banks who created the liquidity. They ran price back into an area of resistance. And now I know there's an opportunity to sell in this area and an opportunity to trade toward this area of support. I go back to the 15-minute time frame, and there are my arrows. I can go to the 5-minute time frame, and there are my arrows. Draw your vertical line. We're overbought. MACD flip. This indicator flips to purple. And what do? We traded toward our RTD, which was below these lows. All right. So hopefully this video gives you some good insight on how we can use liquidity on those higher time frames to dictate price movements. All right. Have a good one, guys.